Welcome back.
Yeah, welcome to the show, Tushar.
Thank you very much. And thank you for having me back. It's really wonderful to be here. So what I did for today was I talked to Tom yesterday, and he had some suggestions. I'll show you what my topics are for today. And mostly I'm going to be touching on financials, US dollar, and my market forecast for the rest of the year. You can follow along with me on my Trend Check blog on the stock chart side. One of the things that Tom did was he had a post this weekend talking about relative strength as a way of looking at for picking stocks. And he had an example of something that had high relative strength and something that had low relative strength. So I'll show you a plot that makes it a little easier to work with. And then he had a question on financials. And so we'll talk about the path of least resistance for financials as a group, and particularly banks, because their earnings are coming up this weekend on Friday. A brief look at the US dollar. And then I'll touch on, are we going to have a summer rally, and with all the news headlines, that's certainly a bit of a challenge. So what I have here is a plot of Scooter on the vertical axis and my Chande Trend Meter on the horizontal axis. So the y-axis Scooter is like a relative strength, relative performance measure, and the horizontal axis is like an absolute performance measure. So you're simultaneously comparing relative and absolute performance. And the two stocks that Tom touched on this weekend was NEWR and PSMT, and you can see that the one he favored, NEWR, had a relatively high Scooter value and also a relatively high absolute trend strength. And then PSMT is low in terms of relative performance as well as trend strength. So this plot is an easy way to look at the entire universe of stocks and ask yourself, what is your trading strategy? If you want to trade momentum and breakouts, you'd be in the upper right-hand corner. If you want to be counter trend, you'll be in the lower left-hand corner. So that's an easy way to look at it. And this week I talked earlier about MKC or McCormick, which is kind of a defensive play. And it had a nice breakout. Now it's consolidating just a little bit. But the point here is that as a result of the breakout, it had very high absolute strength and very high relative strength. So that's the kind of breakout that I like to look at. So this is one chart where you can look at a large group of stocks, plot relative strength on the vertical axis or relative performance on the vertical axis, and absolute performance, or what does the chart look like on the horizontal axis. And then you can pick, say, a value is greater than 80 or greater than 90 to help guide your trading. So this was I thought, somewhat easier than doing lots of comparisons, because it gets harder to plot multiple chart points. Okay, so the next topic I want to touch was financials on their path of least resistance. In particular, I was looking for the KRE and the stocks that are that's the regional bank ETF. And what I did was I looked at all the stocks that are in the KRE, and I asked myself, what is the distribution of the RSI values? So I broke the RSI value, the 14-day RSI, into three ranges. More than 70, they would have a lot of momentum. Less than 40, they'd be weak. And between 40 and 70, they'd be neutral. And the gold line represents the percentage of stocks that are between 40 and 70 have sort of not really any great momentum. The blue line is the one that are more than 70, so they're trending up strongly. And then the orange line is the one with the RSI less than 40. So you can see that the vast majority of stocks, that the gold line is near the top, almost 100%. So that tells you that the majority of the stocks in the KRE have no upside momentum. So as a group, it's really very flat. This is another way of looking at the KRE, which is the dials on the lower level or at the bottom. And I have 4 time intervals. I have short-term, medium-term, intermediate-term, and long-term. So starting with 25 days and going up to 200 days, doubling each step. And I simply applied a trend following model. And I asked the question, is it bullish or bearish? And how many stocks are bullish or how many stocks are bearish? So if you look at the lower set of dials in the short-term environment, just about everything is bearish, which is consistent with the very low levels, with virtually no stocks with having an RSI more than 14 or RSI 14 more than 70. And then if you go from left to right, whether you look at the short-term, medium-term, intermediate-term, they're all negative. Only the long-term environment is on the whole positive. And if you look at financials as a group, which is the upper set of dials, you have essentially the same picture. The short-term environment is very bearish for these stocks. The medium-term environment is also very bearish. the intermediate term is also bearish, and the long term is negative as well. So at the moment, there's very little momentum in the financial stocks as a group and in the regional banks as a subsector. So this is something that, unless you're a counter trend trader, is really not that interesting to look at. The next chart shows you the US bank index, the DJUSBK, and the my trend meter is on the lower panel. You can see that it's just come up to 46 after being down near in the red area below 10. So which means there's no momentum. If you look at the breakout, we had a resistance around 440 that we broke out of, and since we've been coming down retesting the breakout point of support, so we had this very large descending triangle. So this is again consistent with the prior two slides where we have no momentum at all in this sector. So you can decide whether you want to be a counter trend player and maybe buy the lows or the retest at 450, looking for a breakout above the triangle. But as a longer term player, I would just wait till I get a breakout in the whole sector above 520, because I don't know how long it's going to take, and I'd rather not trade it. So from a momentum point of view, I can't really make a strong case for being in the bank stocks. But if you're a counter trend player, then you say, okay, well, there's some good value. Maybe I'll look at it. So that's sort of my view where the bank stocks are going. And what I did was I did a scan for the banks as a group where I asked the question, just rank them by the trend meter. The right-hand column, the extreme right-hand column, is a daily Chande Trend Meter. So the higher the value, the stronger the uptrend. So a couple of things to notice here. There are only a small number of stocks with a value more than 90, which is pretty good. But you see that there are some blank spots for the scooter, but I have values in for the trend meter. So this is just an example where the scooter values are not available for everything, but they are available for the trend meter. So the trend meter is a convenient tool for you to use as an alternative, a sort of a momentum ranking process. And even within the sector as a whole, which is not really trending very well, there are individual stocks that do have some trend strength. So again, if you're really interested in the sector, you think maybe it's come down in support, it might get a bounce later on this year, then you can use a trend meter scan to try to identify the stocks that are still trending well. So if you like the sector, you still have a way of trying to find the strongest stocks within it. So this is sort of my approach to if you want to trade the sector. The next thing I want to touch base on was the US dollar. Now, the next chart shows you what the dollar has done for quite some time. You can see that in the last several years, there's been this well-defined blue line or downtrend, which the dollar seems to stick to. And then this year, we've had the breakout past the trend line. We've had a pretty significant rally up into the 25 area. And then another question is, what's the dollar going to do next? And if you just look at this chart as a whole, you see that once there's a breakout past the downtrend line, the uptrends have persisted for some time. And you can also see that it has come up into some resistance. And if you look at the trend meter down below, it's about 67, still in the green area, but showing some loss of momentum down from the high 90 values. So clearly, there's been some resistance that the market has run into, but I would have to say that the longer-term uptrend is still intact, and you might get some consolidation. So then what kind of consolidations can you get? So you could make the case that if you look at the dollar, you might get an inverse head and shoulders type of pattern. You can see that I've drawn the resistance at 95. And if you go further left all the way across to, say, late 2016, you can see there's some support. There's some support there that the market used to bounce higher. So the 95 level is a good level of resistance. And you can see that we have a pretty well-defined left shoulder and a pretty well-defined head. And now the question is, even if you do have a pullback, are you going to come back and retest support at 91 and maybe form a right shoulder before you continue higher? So now there are a couple of macro issues. One is that the Fed is going to continue raising rates. So as long as US rates are rising, short-term rates are rising, the dollar will be attractive. At some point, Europe will have to also start raising their rates. So eventually, when they get around to it, the interest rate differential will start narrowing between on the short side between Europe and the US. So euro will become more attractive once they start raising rates. So the dollar also will be influenced by the monetary decisions in Europe in particular. So we don't know when they're going to do it. There's a fair amount of chatter about how they're going to start raising their short-term rate pretty soon, maybe next year and so on. I don't really know, but you can make the case that maybe this will be just an extended consolidation to the right-hand side. So I think it's safe to say that we've hit some resistance. There's a potential for it to come back and maybe form a right shoulder. And of course, we don't know what the big central banks are going to decide, and they'll of course have a large role in influencing short-term rates. So that's kind of where I'm with the dollar. I think the bottom is in place, the uptrend is still intact, but the market might consolidate here for a while because we've hit some pretty decent resistance at 95. All right. Then a topic sort of near and dear to me in terms of, are we going to have a summer rally? So I had written a post on this some time ago where I only use a Dow for the reference. And the traditional measurement is to use a Dow because obviously we have a lot of data on that. And typically the logic is that we get about a 13% rally from the May lows into the July, August, September highs. And at the time that I did this thing, we were about 7.6% up from the lows in May, and of course we've had a pullback since then. So the question is, are we going to follow through and have a summer rally this year? So of course, I think we'd all be quite excited if it did. I'd be happy certainly, but it's not quite clear that the Dow is going to make it all the way. So that's the question. Now, if you pull back a little bit and look at the other major indexes since the May lows, you see that there has been a summer rally, but it has been really in the small caps and in the technology-laden NASDAQ. So it's not that the stocks have not rallied, it's just that the Dow has been lagging, particularly the small caps. And the small caps have been responding to the dollar as well as the fact, or the trade wars, because most of the companies in the small cap space have almost all of their earnings only from the US. So if you look at this, the last few days, I went back, looked at the Dow. Of course, today is a different day, but we have this triangular consolidation forming, and then the market broke out, late last week and earlier this week. So we came off the lows. So I would say that on the 60-minute chart, the CTM is up near 80s. You could make the case that market could pull back and retest the Bollinger Bands at some point, but there's an uptrend, and I think that we could probably still muddle higher. And of course, once the earnings kick in, I think the market will have more to go on. So I'm hoping that despite today's pullback, the market will digest the headline risk and focus on earnings and keep working its way higher. Of course, we don't know exactly what it's going to do, but I think short term, even the Dow has a chance of heading higher. Tom already referred to this chart. Mine is from last night, just to show that Caterpillar is really the poster child for the effects of the trade war headlines and for all the trade war worries. You can see that the big red bar on the left-hand side was really their earnings call when they said that earnings may have peaked because they were going to spend a lot of money doing infrastructure development for themselves. The market only heard earnings may have peaked, and we had this big sell-off. And then in June, the sell-off was primarily headlines related to trade. So again, today I know it's down a little bit, maybe down in the 138 area. But this is a good thing to watch in terms of seeing the effects of the trade war. And of course, it's in the Dow, so that certainly has an effect on the Dow itself. This is again something that, this is the XLU chart. Again, you see it had a pretty strong risk-off rally in June when the market sold off. And then we had this very huge retracement bar, kind of broke the uptrend, broke below the 10-day moving average. And then it's rebounded a couple of days. So the question is, are we now in a risk-off mode or a risk-on mode? Unfortunately, I can argue both sides of the coin here, so it's a little hard for me to tell precisely. But I think the very large bar down tells me that we are more in a risk-off mode than a risk-on mode. So that remains. I would love for the XLU to go lower, if you will, so that that would tell me that it's no longer is more of a risk-on market than a risk-off market. But certainly, the one-day sell-off tells you that the market wanted to go higher and aggressively reduce positions or exposure to utilities, the defensive positions. But on the other hand, we've had a bounce for the last couple of days. So, is it the end of risk-off? I certainly hope so. But I think the last 2 days have certainly changed the picture a little bit. This is a little bit broader look at the broad market, the NYSE index. My big concern all year has been that the NYSE has been lagging quite significantly. This is a 60-minute chart, so we can take a little bit greater look, closer look at what's happening. you see that the downtrend line defined by the initial sell-off has also helped contain the subsequent sell-off regions. So you can see there's been parallel channels, if you will, that have contained the sell-offs that also reflect the downtrend line in the big picture. The resistance is pretty clear. We've had resistance in the 1200 to in around 12,800, and then all the way to 13,000. So I think that we're not going to get a significant summer rally until the NYSE can break out or at least reach 13,000 and above. So even though there's a lot of backing and forthing, and I think there was a article in CNBC on how only three stocks, Microsoft, Amazon, and Netflix, account for virtually all of the gains, 71% of the gains in the S&P and 78% in the NASDAQ. So extremely narrow market. And I think this just shows you that the broad market has really just been going sideways. So the double bottom is in place and has simply not been able to rally significantly. So I think for me to be convinced that this is going to be a sustainable summer rally, I need to have the NYSE break through this resistance, which has been quite formidable as if you look across this chart. In the short term, the 200 stochastic RSI is back above 0.8, which tells me there's some upside momentum, but the resistance still needs to be overcome. So this is a good reference if you want to ask the question, is the market really rallying and getting ready to rally? Same picture for the S&P 500. This time I have a 2-hour chart. Again, a 200-bar stochastic RSI is bullish. Market is up against resistance around 2,800. We worked our way past the double bottom. We found some higher lows type of chart. So you can say that you could draw an uptrend channel if you wish. But again, same problem. Until we can break out above 2,800 and hold it for at least a week, I think I would still not be convinced that the market has broken out in a significant way. This is just some doodling more than anything else. So if you just look at the last few, what I did was starting in April and May, I put a little parabola to show the chart, to show the pattern. I just copied it over 3 times. And you can see that the price pattern has roughly followed the parabola. You can see that it is the uptrend. Now the question is it going to go all the way to the top of the trend channel, or is it going to roll over like the parabola suggests? And then what I did was I calculated the price moves for each of the rebounds or each of the moves higher, and I said if I use that count from the low in July, where would I end up in terms of a price target? So I got price targets all the way from 28.15 out to 28.55, depending on whether I took the average value or the average minus 1 standard deviation, and so on. So this is again, I think, a useful visual of what the market is trying to do. It's in some kind of uptrend channel. It's in some. It has sort of a wave-like lurch higher. And we have tremendous resistance overhead all the way up to the highs in January. And certainly we've seen that there's resistance for the broad market in the NYSE. The Dow is nowhere near its resistance from say, March. So the market is kind of moving higher, but really narrow. So, and of course, we know that the rally has been in the short, in the small stocks, small cap stocks, and in the tech stocks. So interesting question. It'll be interesting to see what the viewers think, whether there will be a summer rally or not. So this is sort of a look at potential S&P targets if there is an upside rally for the next little bit. And I'm going to wrap up by showing you the forecast that I did in December. And I said that I expected 2018 to be flat and volatile. And I think we'll all agree that that has been quite an accurate forecast. And then what I did was I made this price projection where the orange line is that I expected month by month. And you see that the blue line, which is the actual S&P 500 performance, has been not too far from my projected line. What's quite fascinating is that my year-end forecast of 2750 is actually maybe more pessimistic than everybody on Wall Street. The Wall Street consensus is around 3,000. Essentially, what's happening is that the year-end S&P earnings are on the order of $155 to $160. So now it's strictly a matter of what price multiple you want to use to project your prices. People are using numbers between, say, 17 and 20. So I don't know what it'll be, but that's how they get their range. And of course, if you look at the bands that I've drawn, any value within, say, between the dotted line and the solid orange line will still be within my forecast. So my view is that we can probably, going into the election, generally August, September, October will be flat this year. Again, another volatile election. We don't know what the results will be, and I'm sure the results will have a big influence on how the rest of the year ends. So on the whole, I think I'm rather cautious. You see that the NYSE has not rallied. My forecast is essentially flat or slightly higher, maybe a little downdraft going into the election season. Um, so that's kind of where I am. That's why my forecast may be more pessimistic than the rest of Wall Street, and still not convinced that we're going to get a significant breakout unless we can get about 2,800 on the S&P. So that's what I have, Tom. Happy to take questions or hear your comments. See what you think.
Okay, well, I clearly think you're more cautious than I am. I'm definitely more in the bullish camp. I still think the market goes higher, but I do have a question for you because you are cautious. How do you approach the summer months? I mean, we know that the summer months historically are not as bullish as the rest of the year. So when you talk about the summer months, you talk about being a little bit more cautious. How does that change your trading strategy? Or I mean, do you hedge? Do you get into more cash? What do you do?
Mostly, right now, I'm still fully invested. I'm waiting for the market to go higher, but I'll use a trend meter to find the stocks that are that have momentum. I'm a momentum trader, so I will use a trend meter combined with other things that'll tell me where the momentum is. So the market will tell me what they want to trade for the summer. All else fails, I'll get out. We are going to ChartCon, and then I believe there's a cruise to Alaska, where I'm sure I'll not have any cell phone reception. So I'll probably be quite defensive then. But other than that, I think just as a trading strategy, I would be cautious, but I'll just trade whatever has momentum. I'm not choosy that way.
Yeah, that brings up some really bad memories for me, because I remember back in 1987 during the crash.
Right.
I got married right before that. I was on my honeymoon. And of course, back then, it wasn't easy to just, pick up your cell phone or, go on your phone and make changes. I mean, you couldn't do any of that stuff.
Nope.
So I literally was out of the country and out of pocket, and I left my portfolio in play and literally came back. I think I had about 25% off. I think it was a 25% off sale in my portfolio when I got back from my honeymoon.
Well, I have been trading for a very long time, and I've discovered that somehow the market knows when I'm not at home and on the road.
I think it does. I think they send signals.
Absolutely agree. I was moving my daughter into university, and I had a huge position in the metals at the time, and it was like as soon as the day after I traveled, and I didn't have access. I'm moving her into her door, and I got hosed.
It's magical. The market knows exactly what you're doing. As soon as they know you can't do anything about it, they're going to reverse on you.
Mm-hmm.
Okay, well, I got another question for you. As you look, looking at your trend meter and all, what are your favorite areas right now? Going through the summer, and does history play a role at all, or is it strictly based on what's happening right now, based on momentum?
It's strictly the trend meter. I know the historical this and that, and this group has done well, and that group has done well, and they all have value. I'm not saying they're wrong or anything. All I'm saying is that the market is already making the decision for me. They're putting their money where they feel the trends are going to be. So my job is to just identify the trend and go along with the herd, if you will. So I'm not going to prejudge if this group is growing and that group is growing. But if I do a ranking by Chande Trend Meter, the strongest stocks will be at the top. So it doesn't matter what sector they're in, and so it'll automatically tell me where I want to go.
Okay, fair enough. Now, again, I think I know what the answer is for you technically, because stocks like Caterpillar have really gotten hit hard recently, and obviously their momentum has been to the downside mostly. But I guess maybe from a gut feeling kind of perspective, do you think that the pullback in some of these big names like Caterpillar, is this presenting an opportunity, you think, for down the road, or do you think you really should just sit back and wait?
Yeah, you should just sit back and wait, in my opinion, because the trouble is that so value is a very squishy concept. If you think of Exxon, right? It was or Enron rather, when it went from infinity to zero. Everybody loved it at 100. They couldn't get enough of it at 80. At 70, they were buying by the bucket, and at 20, they were broke. So once a market starts on a downtrend, I don't want to get ahead of the downtrend unless I feel really strongly about, or I'm trading very short term, and maybe a few days bounce will be sufficient. As an investor, now there are two contrasting views. If you're an institutional portfolio guy, you got zillions of dollars coming in every week. I said, okay, sure, I'll buy it. I don't care. I'm going to hold it forever. So it makes no difference. That's a value player. But if you're an individual, then I would just stay out of it. Why bother? There's so many other things trending higher. Why do you want to guess where the bottom is going to be in Caterpillar?
All right. Point well taken. And in fact, I'm going to go ahead and show my chart that I have on this. I want to kind of get your comments and maybe let everybody take a look at this. But this is a chart of Caterpillar going back the last 2 decades on a monthly basis. And so you can see, obviously, we made a big breakout. We had topped in 2008 with the market getting hit. We finally came back up. We broke out in 2010, had a straight up move. I mean, this is from 60 on the breakout. We broke out just above 60 and traded up near 100. So that was a huge move in about 6 months.
Correct.
And notice what happened afterwards. We ended up coming back down and testing the area of the breakout. I mean, this is just technical analysis 101. Where your prior resistance becomes support.
Right.
And Caterpillar traded in this range for a number of years. And recently, we had another one of those 6 to 9 month run-ups on a breakout.
Right.
And if you look at the chart, I mean, it says, maybe this is the start of a period of weakness on Caterpillar that could take us back to 100.
I think it's a pretty fair analysis, and I think that's how I would also look at this chart. Imagine if you look where your first left-hand arrow is when it first came down to 60. Suppose you said, "Oh, I'm going to buy it over there." Well, it was a good buy, but you had to wait for a very long time before it really had any significant move higher. So that's my hesitancy in buying or being a counter trend purchaser, because I don't know when it's going to rally and continue going higher. Whereas once it starts going higher, I know I just have to have the patience to hold it and absorb some volatility. And I don't have to guess when it's going to start moving higher. So I'm sort of more conservative in that way, or I'd rather have a breakout than be an anti-trend trader. But strictly from looking at the chart, I would say the next really significant long-term buy point is 100, obviously. It's a retest of that breakout.
Mm-hmm. Yeah, I would agree. I mean, I don't know how exactly we get there. Maybe we go back up and hit 160 first and then pull back. Maybe we never go back down there, but you and I both know that many times technical analysis, you think a stock can't possibly go back to a certain level, and it does, especially once the momentum fades on the stock like it has on Caterpillar. We did have a poll, and I wanted to go ahead and bring that up if we could. We were polling the audience to see whether or not they believe we're going to get a summer rally this year, and so I'm kind of interested to see the majority at this point saying no. Well, not the majority, but the highest percentage, 44% going with no, 33% saying yes, and 23% are kind of undecided. I think that's kind of about where you're sitting, I'm assuming, Tushar.
Yeah, well, I think that, yes, I'm sort of sitting there. I want the market to rally. But let's just say that I'm hoping that the earnings season will be a good season and it will push the market higher. In a way, it's good that people think that it's not going to happen. That actually increases the odds that it will happen. So this is a contrarian sort of view. So I'm actually happy that most people think it's not going to rally, which probably means it's going to rally.
That's right. Sentiment being contrarian.
There you go. Well, it was great having you back on today. We certainly appreciate your updated, narrative on what you see in the markets throughout the summer and into the second half. Always have a great time having you on here, my friend.
Thank you so much, Tom. Thank you, Aaron, as well, and look forward to seeing you guys here for ChartCon.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.